Hello, everyone. My name is Vanessa Hernandez, and I'm here with Jorge Reyna and Jeremy Alexander. We are going to be talking about Item 1, Chapter 1, Explaining the Accounting Equation. The accounting equation represents the balance and relationship between assets and claims. Assets are a business's resources that hold some sort of economic value. Businesses may receive these assets from two sources: creditors and investors. Creditors, for example, will give a business owner cash. The company will then use this cash to obtain assets that are necessary in order for the company to operate. So at some point, that money needs to eventually be paid back to the creditors, and this turns into a company's liability. Insurance or taxes may also be considered a liability. The second source a business can receive assets from are investors. When investors provide assets to a company, the company vows to take care of these assets and use them in a way that is profitable to the investor. In addition to the investor lending assets, the company also grants them partial ownership interest, which also allows the investor to benefit in profit that the company earns. This is called common stock. Finally, a business can obtain assets from operations. So, despite a company's income or losses, investors are affected. Though it is not legally required, a company may choose whether or not to distribute these assets received from income. This is otherwise known as dividends. Now, retained earnings are earned profit that a company received once they paid these dividends. So how is the accounting equation changed or affected? Accounting events are economic occurrences that influence change in a company's assets, liabilities, or equity. This sort of occurrence is determined by a transaction. A transaction is an exchange of goods, services, or funds from one entity to another.
No, there are three types of transaction: an asset source, an asset exchange, and an asset use transaction. An asset source. An asset source transaction, there's three types that will affect the equation. One, acquisitions from owners, which will affect equity. Two, borrowing from creditors, which will affect liabilities. And three, earnings from operations, which will affect revenues. Now, as you can see from example one, VAC acquired $150,000 cash from their stockholders. Now, inputting that in the equation, you get the $150,000 cash, you put in the assets. Now, we receive that asset from our stockholders, so we put it from the common stock at which we got the money from. Now, assets could be categorized in notes payable, which means we paid somebody if there was in a different situation, or retained earnings in which we gain a profit. An asset exchange transaction is when you use your cash to purchase land and nothing will change in the formula. As you can see in example two, we acquire the money to purchase land and we put it in the equation and nothing changes, everything stays the same, and all we're doing is just tagging how we moved our money and our assets are the same. Now going back to the asset exchange, we use a historical cost concept when reporting how much we purchased the land. We do this because people have a tendency of using the appraisals of how much it costs now and what it's worth now instead of at what they purchased the land from at. Now, asset use transaction is exactly how it says. You're using the money for something, which is you can use it for use your cash for supplies, salaries, and other notable things. Now, in example three, as you can see, the company used $10,000 cash for operating expenses. Now, how we're going to tag this is we get the cash, we deduct it, and we deduct it from retained earnings, which now you can see the account title we have. That is for us to tag and remind us that we use that money for the expenses of the company or the individual. Now, as you can see, this is the summary of the accounting event. It's showing us This is a sample of the balance sheet of what you will be seeing. Now, left and right side, assets equals liabilities plus stockholders. That is a formula. And fortunately, I came across this example that we could show you of X, Y, and Z company, giving us a fine example of how stockholders' equity and liabilities have to equal to our total assets. This is just to show us within the accounting equation, everything on the left side are the assets of the company or the individual, which is land or cash, and on the right hand of the equation dignifies the source of how the money is gained or lost, but does not signify how much of the actual cash a company or individual obtains.
Cash, retained earnings, and dividends, the spice of life for the accounting equation. So let's talk about cash. What is it? Well, cash is really a current asset that's payable on demand. So, for instance, the paper money we have in our hands, or even the debit cards we carry in our wallets, is a form of cash. And there are several other forms that we can talk about too. But let's talk about retained earnings. How are cash and retained earnings related? The answer is not really. They're two different things because retained earnings are stockholders' equity. Really what it is the profits of a company over time minus dividends and expenses. And we're going to talk a little bit more about retained earnings too. But let's talk about those dividends I mentioned. Now, dividends represent the amount of profit that the business transfers to its owners. They're usually paid from retained earnings, yet the amount that you can pay is limited by the cash that you have on hand. So, retained earnings. Let's talk about it. Retained earnings is a permanent account. And during the normal accounting year, there are 3 temporary accounts associated with it: revenue, dividends, and expenses. At the end of the accounting year, or essentially when you close the books, those temporary accounts are rolled into the permanent account, retained earnings. I hope you understood that bit about cash, retained earnings, and dividends, because now we're going to move on to business liquidations. So what is a business liquidation? Essentially, that happens when a business is mismanaged, and that causes the business to cease operations. And when it ceases operations, it has to give up its assets. And it gives up its assets to 2 primary entities: creditors and stockholders. Creditors are the first line of people that get to take the company's assets, followed by the stockholders. Now, we've done a good discussion about the accounting equation, and hopefully you've learned a lot. One thing we want you to remember, that the accounting equation lies at the backbone of modern society. It's a simple but powerful formula that keeps businesses and governments running. So, like we said, we talked about the accounting equation. We talked about both sides telling a story, just using different terms. We talked about how transactions are really events that happen under the accounting equation. Now they need to be classified properly. And we also talked about cash, retained earnings, and dividends. And then we finished off by talking about what happens when businesses fail, essentially business liquidation. We hope you learned a lot. Please get back to us if you have any questions, and we hope that you enjoy the rest of the semester.